One more time, I'd like to welcome you to the conference. The first sessions, or the session number one, which includes 3 papers, is What Does Empirical Analysis Teach Us About Past Changes to the Tax Code, the Known, Unknown, and Unknowable. It's going to be moderated by Peter Muskowski, who's the Klein Professor of Economics at Rice University and a very good friend. So with that, I'll turn it over to Peter. Thank you once again.
Thank you. Joel Slemrod is the first presenter. His title of his paper is Tax Reform Good for Business. Joel is a very distinguished public finance specialist who's a graduate of Princeton. Go ahead, Joel.
Thank you, Peter. And it's a pleasure to be here. I appreciate the invitation. The title of the conference includes the phrase the known, the unknown, and the unknowable. And I presume it wasn't just me, it was all the authors who got a couple emails reminding us that we should try to weave that into our presentation. I did that by bolding whenever I could. I just did find for no, the word no, and tried to bold all the cases I could find that. But maybe I'm speaking on behalf of all the authors in that I found that a little bit of a daunting challenge, because there's a difference between what's known, unknown, and unknowable to the profession and what's known, unknown, and unknowable to me. And I didn't know exactly what they meant, so I tried to do the former, but maybe I ended up doing the latter. So I've added to my title, which was originally Is Tax Reform Good for Business? It's now that, plus Is a Pro-Business Tax System Also Good for America? And I confess that the very vague title is not due to the organizers asking me to write on this. It was more me suggesting a title like this. And it's a very vague title. What do I mean by tax reform? What do I mean by good? And what do I mean for business? And I try to define these things at the beginning of the paper. But let me start with a few relevant statements. I think there's no question that business prosperity is critically instrumental to American prosperity, and I also think it's not identical. And some of the paper draws out cases where certain tax reforms might be good ideas, but might not be good for business defined in some particular way. And so an example of a case of a policy that might, well, almost certainly isn't a good idea, but will increase business prosperity defined by profitability, is a lump sum transfer. So you raise taxes and you just transfer money to businesses. That's probably not good on distributional grounds, and if the money has to be raised through distortionary taxes, it's probably not efficient either. And I think most people would agree that this is an example of number 2, whether that's done explicitly or implicitly via tax changes. So here's my first example. I bolded in the slides too. So I'm very conscious that I should have something in the paper that was known, for sure. I began by looking at what I could find of a sample of public positions about tax reform taken by business organizations. Although many of these positions are defended as why they're good for the economy, although not all of them, rather than good for the particular interests the association represents, I think it would be extraordinarily naive not to think that these are also the tax policies that the businesses that the association represents think are good for those businesses. So I thought this would be a good place to start. So what I did in the paper is look at, for big business, the major business associations, for smaller business, a sampling of them, and then I looked at some special interest business associations just to see what they, at least publicly, say they think would be good tax policy. And in the slides I just summarize what is shown in more detail in the paper. So I begin with big business. Well, at a broad level, and this is true for just about all the big business and even small business associations, there is a statement saying that they favor making the tax code simpler and fair. Simpler is often associated with a system that has lower compliance costs. And then they go on and make more particular statements about the kind of tax system they favor. That is lower, generally lower, and in at least one case they say no higher, business or corporate taxes. And the quotations indicate that I think the wording is important, and I'll come back and talk more about at least what business taxes might mean. I think corporate taxes, the meaning is much clearer. They also favor a lower cost of capital. Very common is to hear a level worldwide playing field, and transition rules. Well, when they talk about transition rules, they don't say that will make us whole or keep us from losing, but they're just vague words like strong. I put that in quotations. Strong transition rules. But I suspect that means that not only should the new tax system have these characteristics, but in the transition, these interests be maintained. When we get to smaller and medium-sized businesses, there are a wider range of associations, and I don't claim to have found a representative sample of these, but I think I hit the big ones. I mean, I did probably what most of you would do. I did a Google search on business associations and found which ones came up most immediately and most often. And there is actually a difference between the public positions about tax reform taken by these trade associations that represent a broader swath of businesses, not only big businesses. One thing in common is that they favor a simpler and fairer tax system. But then when you get into the specifics, there's a lot more variation across these associations. In particular, some of them support radical tax reform, such as national retail sales tax, or in one case, a tax on business transactions. And I confess I could not tell from the wording of this particular association exactly what that meant, but it was called a tax on business transactions, although some of the rest of the wording suggested that that might also be a retail sales tax, but it wasn't clear to me. And these are suggested to replace the current system. So it's fair to say that some of these associations are willing to support a much more radical tax change, and then other associations apparently are willing to stick with the current system as long as it, for example, ends the bias against saving and investment. And then, of course, there are associations which represent special interests, like the housing industry or the retail industry or self-employed people. And you won't be surprised to learn that when you look at the public positions about tax reform of these associations, they spend a lot more time about tax provisions that affect directly these businesses, that defend and generally extend the generosity of the tax treatment of their sector. So, for example, the NAHB urges the maintenance of tax incentives for housing. The National Retail Federation is critical of a national retail sales tax, and the National Association of the Self-Employed argues for provisions favorable to the self-employed. So one reason that knowing how business views tax reform is that historically business views have been important in what's happened with tax changes. So to remind you of that history, the paper then has a very abbreviated reciting of the role of business in tax changes of the last quarter of a century, starting with IRTA. And IRTA, if you remember, there were big tax cuts in the individual level. There was no tax rate cut for corporations, but accelerated depreciation and other features were introduced. At the time, it was clear that, in general, the manufacturing sector supported the accelerated depreciation, while small business would have preferred, if I can summarize a lot of people's views in one sentence, would have preferred cuts in personal and corporate tax rates. You might remember that pretty soon after IRTA in 1981, a lot of people got worried about the projected deficits and the actual recession, and were having second thoughts about many of the provisions, including the tax cuts, but also the business provisions. And I think it's fair to say that business divided pretty sharply about to what extent IRTA was a problem and should be cut back. As you know, in the end it was cut back, but and in the end the major business associations, this is the National Association of Manufacturers, the Business Roundtable, ABC stands for American Business something, eventually supported some type of tax increase. Most of you are probably familiar with the debate leading up to the Tax Reform Act of 1986, which eventually cut back sharply on the non-rate aspects of business taxation, generous aspects. It cut back on accelerated depreciation and eliminated the investment tax credit. And so there was a pretty sharp division, at least at first, among business interests about whether this was a good idea. And you can probably see how the fault line, where it went, because those sectors which had heavy capital investment thought that the cutback in accelerated depreciation and the elimination of the investment tax credit might not offset the proposed pretty sharp reduction in the corporate tax rate. So there was a fault line there. But eventually, a pretty broad coalition of business, in particular big business, supported the Tax Reform Act of 1986. In spite of, and I think this is interesting in retrospect, in spite of the fact that you remember that although the Tax Reform Act of 1986 was meant to be revenue neutral, it was in projection not revenue neutral both for the individual and the corporate tax systems. In fact, it was a pretty substantial increase projected in corporate tax revenues and a decline in individual tax revenues, which I think it's fair to say was used in a somewhat disingenuous way to sell the Tax Reform Act by calculations of the change in tax burden of representative individuals at different levels of income, not taking into account the fact that the increase in corporate taxes would almost certainly be borne by some of those individuals in some way. And so it was easier to sell the Tax Reform Act as a broad tax cut by ignoring the projected increase in corporate tax payments. Well, I fast forward to maybe for a minute, people thought might be the next episode of major tax reform. This is the Tax Panel Report, which I'm sure everybody here has read through very carefully. And maybe this is most of the people who have read through it very carefully. And it had some very substantial proposals having to do with business. And well, DOA doesn't stand for a government office or a tax bill, but I think it's fair to say that we heard very little from most business about the Tax Reform Act, about the Tax Panel Report, because they could read the writing on the wall that this wasn't going anywhere soon, so there was no need to spend any political capital supporting it or not supporting it. So are they right? We got a sense of what business publicly favors, which I suspect has a lot to do with what they see to be in their interest. I haven't spent much time yet talking about what interest means. For now, just think about after-tax profitability and share price, and I'll talk in a few minutes about when those things might diverge. Are they right? And so I next do a very quick review of how economists think about the impact of taxation, and in particular the theory of tax incidence, which you all know is about trying to understand how different tax systems, how the burden of tax systems, the tax systems is born, and I didn't label that as known, unknown, or unknowable. I think it's pretty clearly not known. It's somewhere between unknown and unknowable. I think so. What I've done is, rather than focus on what we don't know or will never know, to try to talk about how economists, most of economists, think about these questions. So first is that the burden of taxes needs to be traced to individuals. All of you who have taught public finance, I'm sure, at some point say, when you never say businesses bear tax burdens, you always trace it back to some individuals, either the shareholders or the bondholders or the customers of the companies or the workers for the company, but never stop with a statement that a business or a legal entity bears a burden, which is, of course, irrelevant to understanding the answer to the question I pose in the title of my paper: is tax reform good for businesses? A second part, I think, of the consensus view of economists about tax incidence is that incidence depends only on what triggers tax liability, and not at all on who remits the money to the government or who is legally liable. Now, this one is not usually stated as explicitly, but I think is a consensus view among economists. So if we're talking about a consumption tax, all our analysis depends on an act of consumption causes some tax liability. And most of the literature cares not at all about who eventually will have to send the money related to that act of consumption to the government. Whether it be the consumer, the retailer, some other business, that's irrelevant. Not only is it irrelevant who remits the tax, it's irrelevant who has the statutory liability for the tax. And here I mean to distinguish, for example, a withholding tax, where let's say for wages, where employers have the responsibility to remit tax on behalf of their employees, but the legal liability, as I understand it, is on the employees, meaning that if the employer fails to remit the withholding tax, it does not relieve the worker of the liability. So that's going to be very important in understanding the answer to the question, how to figure out the answer to the question of whether tax reform is good for business. And in fact, it calls into question a term that's used quite a bit in the public statements of business associations, and that is, what is a business tax? So at least one of the big business associations said that they were against increases in business taxes. So we're going to talk about what that might mean. And another aspect of the theory of tax incidence, and this doesn't have to be true, but is generally true, I think, of economist studies, is that economic profits do not persist. Well, in a very stylized model of perfect competition and instantaneous allocation of capital to where it can earn the highest return, there's not profits at all. If there's a tax reduction in one sector, you might think that's going to increase the after-tax profitability, but capital moves immediately into there and drives down the pre-tax return so that there's no reward or no higher after-tax return, even for an instant. And if that were literally the way the world worked, it would be really hard to understand why businesses care at all about taxes that look like they're in their interest or not, because the economy works so that it won't affect their after-tax profitability. Well, that isn't how the world works exactly, and I'll talk about that now. So let me talk about one aspect of the theory of tax incidence, which is particularly relevant to this topic, and that's the theory of corporate tax incidence. And here I think it's fair to say that the ultimate burden is unknown. We're going to hear from Arnold Harberger later in this conference, who initiated the modern debate about the theory of corporate tax incidence. We're also going to hear from Alan Auerbach later in this conference, who I don't think is here yet, who has probably done more than anybody else to teach us about theory of corporate tax incidence. And it's certainly not due to any failings of Arnold Harberger or Alan Auerbach that the ultimate burden is still unknown. It would maybe be unknowable if it weren't for the existence of people like that. Okay, so standard models suggest that because of capital mobility, as I said, in the long run, any burden borne by owners of corporate capital will be shared by owners of non-corporate capital. If a tax change or actually any other change makes one sector more profitable than another, that will attract capital, which will in time bid down the pre-tax rate of return. But as I suggested, this doesn't happen instantaneously. And because it doesn't, for example, a reduction in corporate tax rates will cause the market value of corporate shares to rise. If you happen to own shares of companies that get a corporate tax rate reduction, for a while anyway, your after-tax return will be higher than what's earned in other sectors, and that will be capitalized into share prices. So that's why it's not silly for business associations to think it's a good idea to lower taxes on businesses in their sector. It's more complicated than that because many tax reforms, for example, accelerated depreciation, have differential effects on existing capital assets and newly purchased assets. And it is this topic that Alan and others in this room have greatly clarified our thinking over the last several years. For example, if we move to more accelerated depreciation or even to expensing, but not apply that to existing assets, that is going to increase the after-tax profitability of prospective new investments, but it's not so good for existing investments because they are, in a sense, in competition with these new investments which get the favorable tax treatment. So it is perfectly, it's to be expected that for certain tax changes which look like they benefit business, such as more accelerated depreciation, or even expensing, the effect on the market value of a given company could be negative. Yes, for prospective investments, the after-tax profitability might be higher than otherwise, but if that business owns a lot of capital that is now competing with the tax-favored investment, the share value of those firms might actually decline. And for that reason, and now we're to one of the points where I think it's important to distinguish the interests of business and the interests of the economy as a whole, because businesses are both owners of assets, so they care about the value of existing assets, and they're also managers of ongoing operations. And different businesses are different mixes of those two things. So it's perfectly reasonable to expect that if we're talking about a change like expensing or accelerated depreciation, businesses, in their role as owners of assets, will, to some extent, be representing something that has very little to do with the future prosperity of the economy. It's about old capital. Now, it's more subtle than that because you might think that if there's a move to accelerated depreciation or expensing in such a way that the value of existing capital falls, then from then on, business owners might expect this is going to happen again. And to the extent that businesses, when they're making prospective investments, think that policymakers will try to capture a lump sum tax by moving to expensing, that will reduce the expected profitability of future investment. So it could have effects on their ongoing operations. A similar distinction. Hey, Peter, what is my ending time?
5 after 9. You have 10 minutes.
Okay. A similar distinction must be made when analyzing changes in the taxation of dividends. For mature firms, it may be that dividend cuts increase share prices without providing an increased incentive to invest. Now, the theory behind this is very controversial, as most of you know, but there is a theory taken very seriously that suggests that this is yet another case where the interests of business may be different than the interests of the economy writ large, that there could be policies which increase share prices, but have, because they don't provide an incentive to invest, they cost tax revenue, which requires distorting taxes to be raised. So there's another reason one might want to distinguish the interests of business, the interests of the economy looking forward. These issues loom large in predicting the impact of a fundamental tax reform on share prices. Looking in particular at a Hall-Rabushka type flat tax, some people have argued that because of the things I've just talked about, it could lead to a very large decline in the stock market, as much as a 30% decline. But others have argued that if you look at the details of these proposals, such as the fact that they also eliminate taxes on dividends and capital gains, and if you consider the importance in the economy of intangible assets, which are expensed already, so aren't subject to the old capital, new capital distinction I made a minute ago, that these predictions are overstated. And, here the right answer is unknown. And here what I mean is the right answer to the effect of fundamental tax reform on the value of ongoing business operations, which include ownership of old capital. And so if you are representing the interest of business, I think it would be rational for you to be wary of fundamental tax reform. And I think Tom in his discussion is going to talk a little bit more about why businesses are wary of particular fundamental tax reforms. Okay, well, businesses are also tax collectors. Here's a fact which I love. Of all U.S. taxes, this is at all levels, 84% are remitted by businesses. I really should have put in italics, remitted, because I mean businesses write the checks to the IRS. So they write all the checks for the corporation income tax, most of the checks for personal income tax through withholding, all the checks for retail sales tax, most for the payroll tax, etc. So in one sense, this is an aside, when we have these discussions about whether the IRS should engage private collection agencies to help with the business of collecting taxes, and this becomes very controversial. In one important sense, the tax system is already quite privatized. Businesses are intimately involved in the tax collection process, whether for taxes on quote-unquote business or not. And the 84% figure, as you can guess, of course includes taxes that are not legally owed by businesses. And at this point in the paper, I go off on a rant about how in our undergraduate public finance classes, when we ban certain terms and ways of thinking, such as businesses bear the burden of taxes. Here's another phrase I propose. We should ban the phrase businesses collect tax, because I don't understand what that could possibly mean. My best example, one example is a retail sales tax. Imagine you have a retailer who doesn't actually remit any retail sales tax to the state government. They just don't pay. Well, in what sense do they collect retail sales taxes? Now, I've asked retailers this, and they say, well, because we keep separate books, and so we have a separate fund. Well, but if you never really actually paid it, well, in what sense did you collect it? So I think we got to clarify our language, and it's important because these terms are part of our public debate about taxes. So I think. So another example of the difference between the remittance system and the ultimate impact of a tax is the difference between a uniform retail sales tax and a value-added tax. In our standard models, they're equivalent, but most tax administrators will say that the VAT is much easier to collect. You can learn by looking at the business associations that retailers oppose the retail sales tax. It's hard to believe that they do that because they think that it's all going to be borne by them. I mean, if you're in a grocery business and the gross margin is 1% to 2%, you just can't really, I think that a state retail sales tax of 6% means that otherwise your margins would be 7 or 8%. You have a sense that there's a general equilibrium effect on prices you can charge and the cost of the inputs. This difference between remittance and burden is especially important for fundamental tax reform, because a lot of these fundamental tax reforms change who remits tax, and in particular who bears the statutory burden of taxes, much more than they change what triggers tax. And the Hall-Rabushka flat tax is a classic example of that. And so I think it's an important question, given the importance of business stance on tax reform, to think about whether and under what circumstances businesses are fooled by changes in the statutory tax liability. If you look at the latest issue of Hall and Rabushka's book on the flat tax, they in the back they go through how a couple companies' tax liability would change. Business tax liability would change under the flat tax. General Motors tax goes from, I think, $100 million, this is in the days when they made money, from $100 million to $3 billion, and Intel falls from $1 billion plus to a couple $100 million. The changes in the statutory business tax payments of a business under the Hall-Robishka tax probably bear little relationship to the ultimate incidence on these businesses, in the sense of the impact in their long-run after-tax profitability or on their share price. So I think probably a part of it is that businesses are concerned about compliance costs. Businesses, as I said, basically run a lot of the tax system or help run it. We know very little about the compliance costs of these things they do, like withholding and information reporting. Businesses are absolutely key to that. We know something about the compliance cost of the corporate income tax. And in the paper, I summarize some work that I've done about trying to measure what those compliance costs are. The details aren't important. One aspect, though, is, I think, interesting, is that every compliance cost study of businesses ever done, I think, says that they're sharply regressive, meaning that the ratio of costs to some measure of size of the business declines with size. So there seem to be clear economies of scale having to do that are shown in compliance costs. But again, here's where usage is important. That's been called regressive in many studies of business compliance costs. But regressive here means something completely different than what economists usually mean by regressive, which means that the tax burden as a fraction of individuals' income falls as income, as a ratio of income, say, falls as income goes up. That's not what this means at all. In fact, our regressive compliance cost burden with respect to business probably is unrelated to anything about progressivity or regressivity in the way we usually use it. Although most businesses, associations' public statements say they favor a simpler tax system in the sense of lower compliance costs, this is another example where the interests of business and the interests of the country may not always coincide. For example, I think it's true that in some situations, businesses profit from the labyrinthine aspects of the code. Multinationals, in some cases, profit from the fact that different countries have different tax systems and they're logically not consistent with each other. I think it's fair to say that some businesses oppose electronic submission of their tax returns, even though it would be more efficient from a point of view of the IRS. So I think there are examples where, when we're talking about compliance costs and simplification, the general interests and business interests diverge, although we can agree that these are deadweight costs from a point of view of society. And it's also true that some of these compliance costs are voluntarily incurred for tax planning. A paper by a former student of mine suggests that they're a good investment, that if you look at compliance costs relative to taxes paid by big business, it seems like they get a pretty hefty return on these tax planning expenses, which means that it's, from a private point of view, often a good investment, but certainly not necessarily from a social point of view. We know from this research what kinds of changes businesses say would most reduce their compliance costs. And it's not what you might think. It is nothing. They don't talk about radical reform, maybe because they didn't think it was ever going to happen. The two things that come up most often are conforming the financial and tax definition of income. They think that would lower compliance costs. And here's one that's very important and relevant for tax reform debates. They think it would lower compliance costs significantly if there were uniformity among state rules and uniformity between these state rules and federal rules. Well, the reason this is important for tax reform discussions is if the U.S. federal tax system changes, the impact on compliance costs, and generally the impact, will depend on what the states do. Right, the compliance cost savings of substituting for the income tax, a simpler tax, depends on whether the states keep their income taxes or not. Because now they essentially piggyback on the calculations that people and businesses have to do for the federal tax system. Well, Peter just went like this, which either means that he really likes to talk, or there's 2 minutes to go. So I am going to take the second interpretation and conclude. Looking back in the last quarter of a century, I think it's fair to say that wide business support, not unanimous, but wide business support for tax reform was critical to the passage of the Tax Reform Act of 1986, and I think it's true that it would be just as critical in any future tax reform effort. But, warning sign, businesses often have an excessively narrow perspective regarding what would be in their interest. For example, placing a false distinction between what they see as taxes on business and other taxes. Moreover, business is not monolithic, and tax reforms will have differential impacts across sectors, size of business, and legal form. What is good for business is not always the same as what is good for the country, and the paper goes through a few reasons why that's true. First of all, business owners are just one constituency, and a relatively affluent one. So we don't only care about GDP per capita, we care about the distribution of GDP per capita, and across income classes, not everybody has the same kind of income, so that's one reason it certainly isn't the same. And it's also because business owners have interests to protect, which are not directly relevant to future prosperity, such as the value of past investments. That being said, I think it would only be right to conclude by saying, although I focused on where these interests might diverge, for the most part, tax policies that induce businesses to invest in capital and hire workers and to use their resources efficiently are good for America, too.
Discussant is Robert Dennis, who's the Assistant Director of Macro Economic Analysis at the Congressional Budget Office. 10 minutes, please.
Yeah. Well, that was a tour de force, sort of 20,000-foot overview of business tax burden and what business groups think of it. Joel took two basic tax. What do business groups think, and are they? Let me back up a little bit. I've got to say my little bit first. These comments are my own views and not those of the Congressional Budget Office. Moreover, I will be referring to some work by my colleagues, and that also is not necessarily the views of the Congressional Budget Office. Nothing is the view of the Congressional Budget Office unless it's either said by the director or signed by the director.
Was that tour de force part? Was that a
the tour de force? That was a CBO view. Okay, so carry on. Joel has looks at what business groups think, and then groups think, and then asks whether they're right. The groups correctly perceive that tax reform is complex, that they're going to have to think about their own particular circumstances. There are possibly large winners and losers that depend on their own circumstances, and Joel suggests that they focus more on the short run than on general equilibrium effects. So what do they say? How do I change this?
Those
Page.
arrows there.
Oh, okay.
Yeah.
Okay. The first thing I'd like to bring up is tax reform, which we generally think of as being changes in the structure of taxes, but keeping a balanced budget, and contrast that with a sort of broader notion that includes the question of whether current and future taxpayers should, or future taxpayers should pay for today's government. And there's some evidence in the in the statements that Joel put together, particularly in the NAM statements, that business thinks that taxes ought to pay for the current operations of government, presumably because they don't want they don't want to compete with government borrowing, or if even if they think as I do that the effect of government borrowing on interest rates isn't very large, so their direct concerns are not great. Nevertheless, they may have a sort of a public policy interest in keeping keeping government borrowing low. Anyway, that's something that Joel didn't mention. Secondly, there's caution that some people can write sloppily. I'm not including Joel in that, of course. But he did raise the question in his paper of what people might mean by the by business taxes as separate, as distinct from the corporate income tax. So I thought it was worthwhile to ask some business economists what their businesses might have thought about that. And I got a few views. Didn't get as many responses as I was hoping, but I got a few. One view was that there was really no distinction intended. It was just sloppy writing. A second is that this was sort of gotcha protection. In other words, that they didn't want Congress to cut something called corporate taxes and then give them something else with a different label that nevertheless imposed the same sorts of burden. The third is that a third view was that maybe the extra bit that's in business taxes and not corporate taxes was federal excise taxes, or at least some federal excise taxes. And this was put to me by somebody who was involved in the trucking industry. What he was concerned about was fuel taxes and tire taxes. And I think he did take a bit of a general equilibrium view, because what he was concerned about was that a competition from the railways. So it wasn't that they didn't think that, you know, if all the competitors had the extra costs, I think the presumption was that they could pass it on. But if they face competition from a closer related industry that doesn't have those taxes, then that could be a problem. Finally, administrative costs. I think people thought that was a legitimate question, but clearly secondary, and that's consistent with Joel's estimates of how big those costs are. Now, and what I want to go on to do now is to think about a particular sort of tax reform. I'd like to think about moving towards a consumption tax, and that's not because I'm not interested in the base broadening kind of tax reform, but simply that I don't think it's as amenable to the tools of macroeconomics. So the first question is, who would benefit from a cut in tax on capital? If you assume no shifting to labor, then it's going to be the current and future owners of capital. And so there are some really highly skewed wealth distributions, as you well know. This one is just by net worth, and this is if you take out the primary residence. And for the first 6 or 7 deciles of family net worth, there isn't really very much. This is really very skewed to the right. And so what that means is that the argument for this kind of tax reform really has to depend on the notion that the taxes don't ultimately fall, or some portion of these taxes don't ultimately fall on the owners of capital but get shifted somewhere else, and so so that there is a broader benefit from cutting taxes. Well, so how does the shift occur? It's a completely different mechanism from the one that Joel's been talking about, which involves shifting capital from one industry to another, from one type of capital to another. This is the savings, investment, growth sort of story. Back in 1997, CBO did some work on how big the increase in GDP might be from this kind of exercise, and we concluded about up to 10% without transition, maybe 3% with transition. I have to move along faster. So we've done some work to look at the time path of incidence of taxes on capital in a variety of models. I'll talk very briefly about the stochastic heterogeneous Ramsey model and the stochastic OLG model, and we also looked at some alternative assumptions. The first point I want to make is that if in a deterministic Ramsey model, you have quite a lot of shifting of the capital tax to labor, even within a 10 to 20 year period. In fact, most of it is shifted by the time you get to 20 years period in the deterministic model. When you put in stochastics, and what we have here is an individual idiosyncratic stochastics coming from wages, then you get slower transmission to labor, but still a substantial amount of the order of 40%, 50% after 10 years. The other thing to notice here is that whether you use a Ramsey model or an OLG model doesn't seem to make much difference. We looked at the question of risk aversion. Those last figures were assuming a risk aversion of 2, which is the red line in this figure. As you can see, higher risk aversion is going to mean that you have less transmission to labor, but the risk aversion range that our work suggests is most plausible is between 2 and 4, and that's based on work by Elmendorf. The next thing we looked at was adjustment cost, to see what that would do. It's a standard quadratic formulation in which B is an adjustment cost parameter that says how much adjustment costs go up if you increase investment over capital by 1%. And this makes a much bigger difference. And so what this points out is the importance of the adjustment cost assumption. I don't think we have very good estimates of that. The empirical estimates are very high and suggest that adjustment costs are several times the purchase price of capital, which seems implausible.
What do you mean by capital share?
Capital tax.
Oh, we're using the Feldstein calculation. So it's he splits the return on capital into 2 pieces, and one part is just the return on. I'm sorry.
Could we leave this perhaps for the discussion?
Okay, all right.
Because
Okay.
your time is short.
I'm pretty much out of it, yes. Okay, so adjustment costs are important. We also looked at a particular kind of myopia and concluded that that had little effect. Just in conclusion, it's clearly important and relevant to us what businesses want to know. Looking at the statements of business is maybe not foolproof. It would be useful to have a discussion as well as just simply looking at the statements. And then I wanted to expand the discussion of what the actual incidence is from simply incidence among kinds of capital to the question of who bears the burden of capital tax on the long term. And I think this too is also highly uncertain and needs a lot of empirical work. Okay.
The next discussant is Tom Newbeck. Before joining Ernst & Young, Tom was the Director and Chief Economist in the U.S. Treasury Department Office of Tax Analysis.
I appreciate the opportunity to be here, and I especially appreciate the opportunity to comment on Joel's paper and the fact that a paper on business taxes was put first on the conference. Usually it's left to the very end of these conferences. I think Joel, as he does in all of his papers, raises a number of very important insights that aren't talked about very much. And he also writes things that are very thought-provoking. And if you look in his paper on page 24, you'll see that he comments that a paper that Bob Klein and I have done on state and local business taxes, at least from a theoretical perspective, is, quote, at a minimum irrelevant and borders on being meaningless. And despite that, I think we are actually closer to agreement than disagreement, but there are some issues that I'm glad Joel has raised and I think are worthy of discussion even beyond this conference. Now, Joel essentially says that businesses take a narrow view of tax reform, focusing principally on their own change in tax liability. And also he says that businesses have a different view on tax policy because they protect the value of their assets, existing assets. And I guess Joel has the example of how if we gave lump sum subsidies to business, how that could be good for business but bad for public policy. We could take another example of having lump sum taxes on businesses, which I think economists would say must be Pareto optimal because lump sum taxes on businesses would have no economic efficiency effects, but of course could be good for public policy. Well, I think that's where there is this disconnect between businesses and economists. And it is very interesting that both Joel in his paper and in a paper that just came out in Tax Notes that I wrote, both talk about a disconnect between the business community and economists. Joel says, this discussion highlights a fascinating disconnect between how economists view the incidence of business taxes and taxes in general, and how business interests and most everyone other than economists view these issues. And my quote is, with economists and business community differing so widely in their response to the advisory panel's expensing option, many observers are left wondering what caused the disconnect. I think it's up to us in terms of the policy dialogue to see if we can try to bridge that disconnect, because there clearly is. And I think Joel, as always, does a great job in terms of looking for new sources, and he goes to the association websites and finds their platitudes about tax policy and tax reform, and it's very interesting. But I guess at least what I've been told as a parent is kids look at your actions rather than your words, and we clearly know that the words up on the web pages don't reflect any type of budget constraint. And businesses do a benefit cost analysis. As Joel said, they don't invest time in tax reform if it is going to be dead on arrival. I would disagree, and again, it's a matter of degree. Clearly, when businesses look at tax reform, they want to know what is going to change in terms of their actual tax payments to the company, because that's what the tax directors are going to have to report. It's going to be on their financial statements in many cases. But I think, as we saw in this most recent tax reform legislation, businesses do look at the effects of tax reform on their customers, on their suppliers, on the market. Clearly, life insurance, housing, retailers, all were looking beyond just their immediate tax liability in terms of the short run effects. And I agree completely with Joel that they do focus on transition. If we were in immediate general equilibrium and everybody is earning exactly the same after-tax risk-adjusted rate of return, it doesn't matter. But we know that things take a while, and it does matter. So where Joel says that transition is where there's a disconnect between good for business and good for the nation, I definitely agree. And I guess in talking with companies, I have not heard any company ever say that they distinguish between their existing capital and their new capital. Because in fact, when they put in a new investment, the next day, just like when you drive an automobile off a new car lot, it's immediately existing capital. And so they do take a longer horizon and don't make these arbitrary, or as Joel would say, false distinctions between new and existing assets. I guess where I probably diverge from some of my academic colleagues, I would say that institutional details matter, and again, this is a matter of degree. But there are some things that theoretical economists seem to dismiss, which are very important to business. And let me give you 3 examples. One is the accounting treatment of profits and taxes. And economic theory says investors pierce the corporate veil, and thus we can just ignore book profits and book taxes. Well, book taxes matter, and it's interesting that tax depreciation affects the timing of tax deductions, and that results in only a temporary book tax difference as opposed to a permanent tax difference, such as an investment tax credit. And so expensing results in no change in current book tax liability, but it would result in large deferred book tax liabilities. And since tax directors and corporate officers are oftentimes measured on after-tax profits, they are focused on things that have permanent tax differences rather than temporary tax differences, and where the current tax liability is reduced and current book earnings are increased. There's an example where Bob Klein, my colleague, helped the Ohio Business Roundtable get a phased reduction or elimination of the Ohio corporate franchise tax or corporate income tax. It was passed on June 30th. of 2005. By July 15th, corporations in Ohio that had book tax liabilities were reporting increased book earnings because of the future reduction in corporate tax rates in Ohio. And so it does have immediate effects. Also, many economists like a shift to a consumption tax from the income tax because of the efficiency gains that come significantly from imposing tax on existing capital. And it is assumed that lump sum taxes on existing capital are what I call the proverbial free good. And I don't believe it is. If the government can impose lump sum taxes once, they can do it again and again. And once burned, businesses do remember. And that's why businesses made clear that they did not want to pay for individual income tax reductions with business tax increases like they did in 1986. I guess Joel recognizes this in a footnote to his paper. Alan Auerbach talks about the sort of expectations of future lump sum taxes in his paper. Finally, theoretical economists would say don't focus on business tax liabilities, look at the real economic incidence. And this is where, I think it is important in terms of the dialogue that we really help educate the public about who is actually paying these taxes. It does matter. The advisory panel, I remember going to one session where they were talking about the state and local sales taxes, and they ignored the fact that 40% of state and local sales taxes fall on business inputs, business purchases. So it's not a sales tax on final consumer purchases of goods. And it makes a real difference in terms of who bears that tax. A retail sales tax is a destination tax and passed on to consumers. A sales tax on business inputs is an origin source-based tax that can affect location decisions of business. Another example is the sales and use tax that where if you're buying from Amazon.com, Amazon might not collect the sales tax, but you as a customer are liable for use tax on that purchase. Well, Amazon has to collect that tax and remit it. But there are very big differences in the compliance rates between sales taxes with very high compliance by retailers and almost negligible compliance rate by consumers in terms of the use tax. And that is why Main Street is concerned about sales taxes not being collected on remote sellers. So I guess in terms of known, knowable, and unknowable, I think it is a real important for us to figure out what is knowable, but then be sure to translate it in terms of what is known by the public. And I think this issue of lump sum taxes on existing capital being a free good that many theoretical economists or proponents of consumption taxes think is something that we should really talk further about.
Thank you. So now, we'd like to end the panel. I'd like to throw the floor open for discussion.
Joel, it's actually saying Drew didn't come. One of the things that sort of bugged me about the things we know and the things we don't know is that, like, suppose we have a big investment tax credit in your, Intel. And I guess there's a little competition from AMD, but mostly Intel's out there, making chips with a big footprint, and no one's going near them. Suppose you're a cable company, and you've captured your regulator. Then basically the investment tax credit just makes it easier for you to make your monopoly profits in the future, and your price goes up if we have it. Drew's, I think, maybe someone else has seen it. Drew's paper is the only thing I've seen on this, where he shows that when we have reductions in the marginal cost of investment, that the value of old capital goes up empirically, which is kind of intuitively sensible to me, because the guys who have the biggest market caps, right, are going to be the guys who have footprints such that this might be true. At the very least, the things we could know is to suggest that somebody should write a paper, like look at the partial expensing, and because it expired in the year it's expired, if you had like a fast depreciating equipment, then there would have been people coming in to compete with you. If you didn't have any market power, and your market cap probably should have been affected, but if you're a cable company, maybe it shouldn't. Why didn't you talk a little bit about the Drew thing, and have you seen anything else on it?
Thanks for the comment, Kevin. I don't have much to say about the Drew thing. I mean, I do.
Yeah, it's like 20 years old now, right?
I do agree with you that 99% of the papers about tax incidents are about models of perfect competition. There are a few about oligopoly, and I say it quickly. The paper. The problem is, as many different models of oligopoly there are that many different implications of the models for the incidence of tax. That's not to say the presence of monopoly and oligopoly isn't important. It's just that I think in the continuum of known and unknown, I agree that those sorts of questions are more on the unknown end. And if I were in charge of NSF money, I think, Kevin, you and I agree that we should spend more time thinking about those things.
I was intrigued, Joel, by your discussion about sort of the corporate governance paragraph or so in your paper about whether it's management or shareholders that are driving business position. And I was wondering if anybody's done any work on that. It would seem like an easy thing to do. You could take like IRDA or something like that and see how the public positions relate to maybe the share price changes. It seems like IRDA. It seems like that would suggest the fact that business favored the accelerated depreciation strongly across the board suggests that it was management driven rather than shareholder driven because of the adverse effect on old capital for accelerated depreciation. I just wondered if you have any further thoughts on that dichotomy between those two.
I have a couple thoughts, but I want to ask a clarifying question. So when you distinguish between shareholder interests and manager interests, how do you think they would align differently, say, with IRDA? Yeah,
well, I guess the sort of like first cut thing might be to say that the managers are more interested in ongoing operations and ensuring that they're profitable, that they avoid bankruptcy. If there's a temporary adjustment clause thing, that's even better. So just the traditional things, managers are risk averse, want to avoid bankruptcy. They also would like to expand their operations, have a bigger business, sort of independent of profitability. And so that would suggest that they would tend to favor accelerated depreciation in situations where it might not be good for the shareholders. And I would suggest in IRDA that it seems to me that just using the traditional framework that you've set up, that you predict that IRDA would have been more divisive than it was, that you would have found businesses opposing it because of the impact on their existing assets, at least some of them.
Well, I take that as a fascinating question, and more NSF money for that. Actually, what I had in mind when I wrote that cryptic paragraph was not so much what you're talking about, although I now think what you're talking about is more important than what I had in mind. I had in mind some work I've done with Keith Crocker looking at how tax enforcement policy might have different effectiveness depending on whether the penalties for non-compliance are put on the corporate body or on the managers, and in fact it does matter. And the key assumption is that tax policy might change the deal, the contract that the shareholders have with the managers, and which could offset to some extent some policies. I resisted citing my own paper on that, but it seems that it was so unclear that I have to cite it now. But
Yeah.
Can I say one more thing just one more thing to that question. I don't know of anybody who has tried to rigorously distinguish the interests of the shareholders and the interest of the managers in the way you laid it out, and then tried to empirically find evidence of that. But that would be a great paper. Yeah, I'm sorry.
Well, actually, I do. So the Arlen and Weiss paper in the Yale Law Journal, late 90s, I think you really have to look at it, because it looks at, it surveys managers, and what it looks at generally, picking up that best point, it's the political economy of this. So the argument is that managers, like, you don't talk about the retained earnings trap, but managers actually like the corporate income tax, oppose integration, because they like the retained earnings trap, which is clearly if you view shareholders as a proxy for welfare or economic maximizing, which they, I guess, ought to be in equilibrium, that's a clear divergence. And so the whole Arnold and Weiss study, and I agree with the comments about not just looking at websites. Dan Shapiro pointed out to me, the good thing about cheap talk is that we can afford a lot of it. You can do a lot of cheap talk, but what Arnold and Weiss actually show, and you should have similar stories around the dividend cut, because the sort of opposition to the dividend tax cut, which you can find empirical or anecdotal journalistic evidence of. So the idea is that managers like the retained earnings trap, and they like tax reform that justifies the retained earnings trap and that sort of inframarginal. So the accelerated depreciation and the investment tax credit. And I think the same kind of thing, whatever you do with incidence and your general equilibrium of the passing on of business taxes, you're almost certainly going to have scale effects. So, certain taxes which you pass on, if they're passed on through the price of the goods, are going to, change the size of the market. And if managers are interested in scale, because they like sort of bigger companies, they have more power, they have more entrenched power, whatever. But if there's a principal agency problem and managers like scale, they're going to diverge. And Arnold Weiss basically is a good source for a good starting point for that.
Sorry,
Yeah, Bob, I'm still confused about the capital share of, I guess, the tax burden, because these Ramsey models are just one infinitely live calcium, right? So the burden of any tax is right on that.
Yeah, it's defined by, essentially taking the return on capital and splitting it into two pieces. There's one part that's a payment for deferring consumption, and then there's another part that's the payment for the remaining return on capital. And it's that other piece is what we're looking at. This is a strategy that Feldstein did, I think it was 74 or something like that. Actually, there may be a slide in my presentation that I should give you the formula, but if not, I can give it to you afterwards. I think what we did was right, but.
Tom, Joel, one thing that's always has puzzled me is that it seems like I don't even know how to phrase this. It seems like that a lot of corporate CEOs will probably, at least privately, prefer to have a tax system without much broader base and much more neutral among companies. Even their companies can individually benefit from all of these kinds of tax gaming strategies. The question is there a constituency for leveling the playing field, or would companies really like to just compete based on how they produce goods and services rather than how well they do in the tax area? Is there any evidence on that?
I cite something from the history of the 86 Act, where I think it was 86 Act, where at some point the Broad Business Association suggested strongly to their members that they not push special interest provisions. I don't know if that has to do with the private views of the CEOs versus the interests of the business community writ large.
I'm not familiar with any specific examples, but again, businesses will try to see what the lay of the land is in terms of the politics, and if there's a pot of money that policymakers are going to allocate to business taxes, and that's a tax cut, and the only thing available is the R&D credit extension, they will support the R&D credit extension. And it isn't as if they necessarily have a choice of trading off a small amount for the R&D credit versus a minuscule reduction in the corporate rate. But there are a number of companies, large companies, that would look very favorably in terms of lowering the corporate rate, because it reduces a lot of the distortions. And just like on the individual side, when you lower marginal rates, it reduces the value of a lot of the tax expenditures. If you lower the corporate rate, it also lowers a lot of the value of the corporate tax expenditures. It'd be nice if people had a specific choice. When we've done a survey for the Tax Council Policy Institute, a majority of the respondents of large multinational, multi-state businesses do favor a lower corporate tax rate compared to a host of other tax reductions.
Would they favor paying for that by broadening the base and getting rid of a lot of special tax provisions that they're individually taking advantage of?
There are quite a few that would, but again, it's heterogeneous, and if you ask a survey question that's hypothetical, it's hard to exactly know. I mean, clearly in the case of the 1986 Tax Act, where there was significant reduction in the corporate rate with significant base broadening beyond just repeal of the ITC and scale back of the depreciation, but a lot of other corporate tax base broadenings, there was a lot of corporate support.
Joel, my impression in observing what business says over through many tax changes is that, certainly what Tom said, I think they do a lot of looking at their bottom line, or possibly their demand. So, Ford might like investment credits or things like that. But as far as I can tell, they have never been enthusiastic supporters of the flat tax. And if you think about it, there's a lot to lose there for some companies. You lose the interest deduction, you lose old depreciation deductions. I remember particularly, I think the Ford was very lukewarm towards this because under the flat tax they would pay the tax on fringe benefits. And they had as we all know, in the auto industry, fringe benefits are a really big deal. And I'm sure that there were newspaper articles back that kind of spell out some of these things. The other thing, and so you might want to, if you have some access to LexisNexis or something like that, back in the past.
Howard Bushka had GM in their book, and they talk about it. It's like a $3 billion change.
Right. So the other thing is that it seems to me if I were a business, I would be very worried about radical change. Because it's risky, it's disruptive. I mean, maybe you could do really well, but maybe you could be in a big disaster. So I think to the extent anybody's risk averse, they're going to be, hesitant to endorse the flat tax. Frankly, I think all these consumption taxes, people love to talk about them for political reasons, but the bottom line is, if there's anything history's taught us, is we never change anything very much. And boy, that would be a big change.
Except in 1913, I guess. Can I respond to that? You said a lot of things, Gene. I agree with almost all of them. I agree about the conservatism of business positions, but it is fair to note the difference, at least in the stated positions, between big business and small business, where a lot of these small business associations claim to be for radical tax reform. About the big shifts in tax liability going to the flat tax. It's absolutely true. Holland or Bushka have these examples with a huge increase and a huge decrease of two firms I cited in my paper. Of course, that's just the sort of thing we got to be careful about, because that isn't general equilibrium at all. If we shift the responsibility of remittance from the business to the individual, and the flat tax does that in a lot of cases, if we think ahead, it can't be as good or as bad for the business as the bottom line business tax liability suggests. Now, I don't know. Yes, I agree. That is an important question. But your example raises an important special case, which is in the presence of existing contracts, such as Ford's contracts with its workers. If moving to a flat tax can somehow get them out of the contractual liability to pay health care for their workers, that is a short-term thing, but that's a lot of money and might save them. I hesitate to utter it, but I'm not in Michigan. Might save them from bankruptcy. So of course that's going to influence their position. So general equilibrium analysis generally ignores the fact that you're locked in to some things maybe based on nominal magnitudes or contractual magnitudes.
We have time for one more question.
One of the problems that's raised by Len's question is the lack of a pre-commitment device. It seems to me that even if business, in some sense, would prefer a more neutral tax system, they can't easily advocate that, because undoubtedly there will be somebody else that will defect, and then the advocates will end up with the short end of the stick. Even in '86, when you look at the businesses that were supportive of tax reform, they were supporting tax reform out of their self-interest. They were supporting broadeners which for the most part, didn't really benefit them, and they thought that they were buying off the trade-off of a lower rate. There was a little bit of a pushback, if you remember, when they went from Treasury 1 to Treasury 2, or at one of the versions where suddenly there was the movement to higher corporate taxes. There was a bit of a resistance at that point, but even then, I think the businesses did their calculations and determined it was in their self-interest to support.
Can I respond to that with an almost completely unrelated anecdote, which I thought I put in the paper, but maybe I took it out. But I thought this paper was my chance to write it down. Between Treasury 1 and Treasury 2, I was at the CEA as senior staff. And so November, the Treasury 1 comes out, and a lot of businesses were upset about the proposal to get rid of the investment tax credit and scale back accelerated depreciation. But there was a dividend deduction. Right? So I remember well, as a very young economist, being in the chairman's office when a few business representatives, a big business, came in to complain about the Treasury 1 proposal, in particular the investment tax credit elimination and the accelerated depreciation cutback. And I meekly at one point said, but what about the dividend cut? Doesn't that offset this to some extent? And I swear that one of the guys looked at me and dismissively said, that's for the shareholders. So this is Ted's point.
Okay, we'll take a 15-minute break and regroup at exactly 10 o'clock.